a warm Southwest Florida welcome.
Well, Gary, thanks so much for that introduction. When I got off the plane, I knew I had made a good decision coming to Naples. And I've got to imagine that this is, in your seasons of the year, this is the smug season, when you watch the Weather Channel and see what's going on in Boston, for example, and you think, boy, I'm one of the smartest people in the country to be here in Naples. I want to begin by expressing my thanks to Gary for his service on our Miami board. This is our board for South Florida. And Gary's advice and Gary's insights into what's going on in the economy in this part of Florida is invaluable. And we really do appreciate your service. Gary follows Gay Rebel Thompson, Gay's right over here, who also served as a board member and served as chair of the board for South Florida. This year, 2015, is widely expected to be the year the Federal Reserve initiates what's called normalization of monetary policy. This prospect has generated a lot of interest and buzz. I'm having technical difficulties. Here we go. All right. If you follow the Fed watching industry as I do, you're well aware that a top-of-mind question regarding policy is, at what meeting will the Fed decide to lift off? At what meeting will the Federal Open Market Committee raise the policy rate above its current near zero range? If you're an investor in fixed income or interest-paying assets, a lot of money may ride on the answer to that question. In contrast, if you're a business person operating in the non-financial, what economists call real economy, you may be less concerned about the precise timing of the first policy adjustment. You're likely to be more concerned about what a change in the interest rate environment means for the outlook for overall demand conditions in the economy and the general direction of the economy. Today I'm going to orient my remarks mostly to the concerns of Main Street. This keeps the focus where, in my opinion, it ultimately should be in policy terms, and that is on the health, resilience, and momentum of the broad economy. With this perspective in mind, I want to share my thought process as one policymaker on the decisions ahead, most likely in 2015, and the economic context in which those decisions will be made. When a Federal Reserve Bank president speaks publicly, he or she is expressing individual views, not an official message of the Fed or the FOMC, and that's the case today. These are my individual views. The national economy has improved greatly from the recession's trough in 2009. Much has been accomplished. The Great Recession was a particularly severe period, a severe episode. The economy lost quite a bit of ground. We lost nearly 7 million jobs, more jobs than in the prior 3 recessions combined. During the recovery, we have regained that ground, and non-farm payroll jobs are now about 2 million jobs above where they were at the onset of the recession. In terms of total output, the economy is almost 14% larger than at its nadir at the bottom of the recession. It's taken a while. The recovery is 5.5 years old. And in my opinion, the job is not finished. But as I said, much has been accomplished. I believe the economy has sufficient traction for the expansion that we have been experiencing to be extended at least through the medium term. My baseline outlook for 2015 and 2016 assumes growth at around 3% per annum. I expect employment to continue to grow and both unemployment and underemployment to continue to decline. This morning, we received the Bureau of Labor Statistics Employment Situation Report for January. Payroll jobs grew by 257,000 on net, with upward revisions for earlier months. Over the past 3 months, job gains have averaged 336,000. As a general statement, the improvement of economic conditions to date, in combination with the outlook that I just outlined, lead me to the view that the economy is on a path to a satisfactory and desirable state of health. The Fed's statutory objectives contained in the so-called dual mandate help define what is satisfactory and desirable. Our policy objectives are maximum employment and low and stable inflation. The Federal Open Market Committee, the committee, has put a clear definition on the inflation objective. We've defined it as a rate of 2% annual inflation over the longer run as measured by a particular index called the Personal Consumption Expenditures Price Index. Importantly, inflation is targeted on a total or headline basis, including the highly variable components of food and energy. In practice, most Fed officials monitor a collection of inflation indicators in an attempt to discern the underlying trend. There are worrisome aspects of the current inflation picture, and reading underlying trends is problematic at present. So hold that thought. I'm going to emphasize the centrality of inflation concerns a little later in my remarks. Maximum or full employment is less explicitly defined. Most economists assume that what constitutes full employment changes over time. Structural shifts in the economy cause the natural rate of unemployment to move around. For a good part of the recovery period, a number of Fed policymakers, me included, have estimated the unemployment level consistent with full employment as between 5.25% and 5.5% or a little higher. Today's report has the headline unemployment rate at 5.7%. So on that basis, we would seem to be approaching an acceptable steady state level of employment. It's a fair question, then, why the FOMC has not already started to normalize interest rate policy. My answer is the recovery has been sluggish for much of these 5.5 years. To accomplish what we have accomplished, the recovery has required the support of extraordinary policy measures such as a policy rate set at effectively 0, and 3 rounds of quantitative easing. Furthermore, the economy has endured periodic headwinds that threaten to dilute or reverse progress. And although the economy is growing, its strength has sometimes seemed tentative and fragile. A moment ago, I said the job is not finished. Gaps remain. Employment progress, for instance, may be less than meets the eye. Many of us have held that the conventional measure of unemployment probably understates actual progress. There are still almost 7 million workers counted as employed who say they are working part-time involuntarily. As a point of reference, 7 million is about 4.5% of a labor force of 157 million. There are always people in this involuntary part-time category, but the number is still elevated compared to historical levels. Over the last few years, in addition, there has been a worrisome outflow of prime age workers, especially men, from the labor force. And I believe some of these people will be enticed back into formal work arrangements if the economy improves further. The distance, the gap between current conditions and our goals doesn't have to be completely closed to start moving interest rates higher. Monetary policy is of necessity forward-looking. If, as we look forward, it seems likely we will achieve our policy objectives, then we can consider beginning to adjust policy. From a Main Street perspective, it is the overall direction and extent of normalization that should matter most, rather than the exact date of liftoff. Liftoff will be a momentous event when it happens, but it is the evolution of the interest rate environment over the next few years that will most influence real business activity. The linchpin in a decision to make a significant policy change is confidence. By that I mean confidence in a forecast, an outlook narrative, if you will, that has the economy on track to achieve the committee's policy objectives in a reasonable time frame. I think a reasonable time horizon is 1 to 2 years. I really want to emphasize this point on confidence. The committee has repeatedly stressed that the first and subsequent policy moves will be data dependent. It is confidence based on clear evidence in the data that should trigger the start of normalization. 100% confidence is never attainable. The test, in my mind, is one of sufficiency. That is, sufficient confidence that in a defined period of time, the broad economy will reach conditions consistent with sustainable full employment and stable prices. At this particular moment, in February 2015, I don't quite have sufficient confidence. There are factors at work at the moment whose effects I consider to be transient. Key among these factors is inflation. Inflation, by almost any measure, almost every measure, has been running considerably below the FOMC's target of 2%. This was the case well before the recent drop in oil prices. Because of the sharp fall off of energy prices, especially gasoline prices, headline or total inflation has gone negative in the most recent readings. Core inflation, the measure that excludes the direct impact of energy and food prices, has recently been running below 1%. In my baseline forecast, I have inflation getting past this period of broad disinflation and resuming a gradual rise to 2%. It's important, in my opinion, to be confident that this will occur. And certainly the trend in overall prices is not, it's important to be confident that it is not continuing to move away from the FOMC's target. Just as current readings of inflation give some pause, broad wage trends seem to suggest that we are not yet on the cusp of full employment. The quite modest growth of wages across the economy does not seem normal given the solid growth numbers we've seen in recent quarters. Inflation and wages ought to be telling indicators that the gaps are closing, and their weakness is a concern. The first half of 2015, in some respects viewed as the run-up to a policy change, will present some challenges in evaluating the validity of our economic assumptions. I've mentioned oil prices. After 7 months of decline, prices firmed in trading sessions last week, then fell again. Financial market participants interpreted the firming as a positive development. That said, a number of oil and gas sector analysts forecast that global petroleum supplies will exceed demand through the first half of the year, suggesting further softness in oil prices. The dollar has appreciated by 13% on a trade-weighted basis since last June. Exports in the fourth quarter seem to have been negatively affected by the dollar's rise. I'll avoid predicting exchange rates, but suffice to say that the impact of the dollar on exports, as well as imported consumer prices, is part of the current swirl of variables making the state of the economy harder to assess. The direction of the dollar is an aspect of a larger context of slow global growth with risk of spillover to the U.S. economy. Some of the influence of soft economic conditions abroad is actually incorporated into my baseline outlook. In contrast, more extreme scenarios are not. I should also comment on inflation compensation in inflation-protected securities. Compensation for inflation in these securities, so-called TIPS, or Treasury Inflation-Protected Securities, has moved sharply lower since last summer. This decline may reflect transitory influences like falling energy costs. A less benign possibility is that investors are lowering their outlook for inflation. And this could be either because their confidence is waning that the Fed will achieve its 2% inflation target, or because they see growing risks to the continuing strength of the broad economy. Since mid-January, some inflation compensation measures have shown signs of reversing. Affirming in the inflation compensation data from their year-end lows is an example of the kind of encouraging development that will bolster my confidence in the medium-term outlook. So to put an exclamation point on the proviso that the first half of 2015 may be noisy and hard to read, I'll just catalog a few of the obvious things that might confuse the underlying conditions. Oil prices, the dollar, the effects of both oil prices and exchange rates on headline inflation, their possible impact on core inflation, slow to improve wages, the ups and downs of quarter-to-quarter growth, and mixed messages from measures of inflation expectations. So if the linchpin in a policy decision for me is confidence, what am I looking for? For starters, as I said earlier, key indicators of economic conditions should not be moving away from my baseline outlook. But assuming no substantial softening of gross domestic product and employment growth, my attention will likely be on the path of inflation. I'd like to see some evidence that what we believe to be transient factors driving recent weak inflation are in fact passing. I'd like to see firming of inflation readings. This will give me confidence that the outlook on which important decisions will swing remains realistic and likely to play out. Inflation is appropriately a focal point because its firming will reduce concerns that the economy is somehow stalling, that prophecies of long-term stagnation have any basis, and that chances of accomplishing the FOMC's policy goals are receding. As of today, I remain comfortable with the assumption that circumstances will come together around mid-year or a little later that will deliver sufficient confidence to begin normalization with the liftoff decision. I won't be more definitive than that. I think all possibilities from June on should remain open. I don't, at this juncture, have a prediction or preference. Timing will depend on what the data tell us. From a Main Street perspective, the important point for business planning is that monetary policy is likely to shift this year, and a higher interest rate environment will ensue. The decision to begin normalization should be a signal that the Federal Open Market Committee is confident the economy is on track to achieve its objectives and that the economy should have sufficient strength and momentum to handle higher rates. The start of the process of normalization should itself instill confidence on Main Street. I'll stop with that thought, and I'd be happy to take a few minutes to answer or respond to questions. Thanks very much.